So today we're going to be talking about chapter 26, which is capital investment analysis. All right, and so last chapter, we were talking about differential analysis, and really we applied that rationale to pretty much making decisions. All right, and so generally the process of making decisions is the same. You find out, or you identify what the question is, right, or what the need is. You look at your options, you consider the differences between those options, and then you select your choice. Now, continuing with that, especially from a managerial perspective, at some point you want to evaluate that decision, right? And so, to kind of wrap up chapter 25, at some point you're going to say, hey, was that a good decision? Did I include the information that needed to be included? So that it will help you the next time you need to make a decision that might be similar, right? Well, chapter 26 is a little bit different. It's still tools that managers can use, right, to help them make decisions. Kind of a little bit more different than last chapter. This one has to do with capital investment, right? And so if you think about what a capital asset is, right, really a lot of times those are fixed assets, right? Again, what are fixed assets? There's land, buildings, and equipment. All right, so a lot of times when people are talking about capital assets, really they're talking about the assets that you're using in order to make your business go. And so I always use this example. Um, Southwestern Michigan College. They have to have a location, they have to have a building, right, and they have to have rooms. Well, it just kind of maybe put to question recently with the pandemic and we doing everything remotely or online. So it's a little in question these days. But I use the example. Hey, if you had the choice of coming to SMC and sitting in the middle of a field, right, versus going to LMC, okay, and being able to go into a building, you're probably going to choose LMC. Right? So we had to have the building so that students would come and generate revenues, right? And so that was the whole aspect of depreciation, where we match those expenses against those revenues and stuff. Well, the same thing applies for equipment also. And so chapter 26, what it does is it looks at 4 different tools to make decisions about which fixed assets you should purchase, all right? And so I'm going to take my video down and so I can write on my tablet that has my camera, right? And then I will go ahead and share, all right, chapter 26 with you. And get it up a little bit. Okay. And share screen. All right. And so chapter 26, all right, capital investment analysis. And so we kind of need to know, all right, a little bit, the nature of capital investment, all right, analysis. Company use capital investment. Again, whenever you see this, all right, I really want you to think about, the fixed assets. So let me be able to draw on this. There we go. The fixed assets of a business, all right. Property, plant, and equipment, all right, land, building, and equipment. Those are all considered to be fixed assets. So, oops. And so capital investment evaluation, all right, as I said, there's 4 different methods, all right. 2 that do not, all right, use the time value of money, okay, and 2 that do, all right, that use the present value understanding, all right. And so hopefully at some point in your educational career, you've talked about the future value and the present value of numbers, all right. In a nutshell, what that refers to, all right, is the time value of money. Okay, the time value of money basically says, hey, if you had the choice, right, if you had the choice to have $1 today or $1 sometime in the future, all right, and so we have a timeline, okay, Would you rather have $1 today, okay, or $1, okay, a year from now? Well, hopefully you'd say today, okay, because this is the present, right, and this is the future value. Okay. You'd want to have that dollar today, right? Why? Because the time value of money, right, is really interest. See, if we had that dollar today and we invested it at 10%, okay, we would grow this dollar, kind of unequal line there, not straight line. All right, we'd have $1.10. Right? Does that make sense? Okay. That's the time value of money. So, um, whenever you need to make a decision, and that's what we're trying to do in this chapter, we're trying to decide, hey, should we buy some new equipment? Might be more efficient, or should we maybe, um, expand our building, so, put an extension on our building, right? So we're looking at those two things and which one should we choose, right? Or maybe we're just looking at, the purchase of new equipment and it's like, hey, should we do that or not, right? And so when trying to make a decision, it's important to understand what your options are, right? And so let's just say that, there's two proposals before us. It can be whatever you want. Buy equipment, expand your factory. Okay. How many options do you have? So think about that, right? You have two proposals. How many options do you have? Well, you could either choose, proposal one or proposal two. So there's two options there, right? You can choose proposal one, right? Or you could choose proposal two. Or you could choose both proposals one and two, or you could actually choose neither, right? And so, identifying your options, it's good to know that, right? You don't have to buy these, or if you have enough money, you could buy both of them, or you could buy one, or you could buy the other, all right? And so you really have, with two different proposals, you have four options that you need to consider, all right? So we're going to be looking at these things, all right? These ones are weak. Okay. These ones are strong. Okay. And this one is the best. All right. It kind of cracks me up because the way that this textbook teaches the internal rate of return, the IRR, right? It's pretty lame. All right. Know that in the real world, all right, you're going to go out and buy yourself a B, or I should say a Texas Instruments BA2 Plus. Okay. This is a calculator that, if you're going to be a business major, I would advise going out and buying this calculator. All right. You generally can find them for about $25, on Amazon, or I actually got mine, I think, for $23 at Walmart. All right. But the Texas Instruments BA2 Plus, it's a very powerful business calculator. And yes, I allow, because I tell you that there are calculators I don't allow on exams. This one I do. All right. It's a business calculator. And just FYI, if you are planning on doing the Ferris program, all right, you might want to consider that. Again, if you're unaware, I'm sure you are, but you can basically do 3 years at SMC, paying SMC prices, okay, and 1 year through Ferris, and get a business degree in either human resource management, accounting, or business administration. Right? It's probably one of the best deals that you can get, a 3-for-1. Uh, you know, and get a bachelor's degree. All right. So if you are interested in that, I happen to be the academic advisor for Ferris for business class, or you can talk to Andrew Churchill. He's also on our campus, right, at SMC, and he's really the admission advisor. Right? And so if you're interested in that, I highly recommend looking into that. It's probably the cheapest way to get quality degree, right, through through Big Rapids, Ferris State University. So why I brought that up is this this calculator here. If you do go into the business program through Ferris, there's a class that I happen to teach that this calculator is required. All right, and so you're gonna have to buy it anyway if you're gonna do the Ferris program, and so you might as well get it now because it will definitely help you in your business classes. Right, and what it does is it helps you to calculate the time value. Okay, and so I did want to bring up, the, when we're talking about present value and future value stuff, um, know that whenever you're trying to make a decision, you want to bring everything into the present value. You want to bring that into the present because this is the day to make the decision. Today is the day to make a decision. Make sense? Any questions? All right. Okay. And so moving on. All right. The two methods that use present values consider the time value of money. All right. So we kind of already talked about that. Methods not using present value or time value of money. All right. Why we can talk about them is that they're quick and easy. All right. So they're relatively easy to, you know, uh, to calculate. So if you're out in the field, all right, you can easily run one of these scenarios if you're trying to make a decision on the fly. If you forgot your calculator at home, all right. And so there's also a difference between what are we looking at, all right? Because one of these methods, all right, the average accounting rate of return, just looks at accounting numbers, all right? Where all the other methods, all right, the cash payback period and the two that do take into account time value money use net cash flows, all right? And so you guys are, I'm sure, all familiar with, net income and whatnot, all right? And so, those are accounting numbers. Those numbers include things like depreciation expense, which is a non-cash expense, meaning you don't use cash to incur that expense. We talked about that when we talked about the cash flow statement. Whereas the net cash flows really looks at the cash inflows and outflows from a specific proposal. So the average rate of return, this is the first method that does not use the time value money, is really easy. It just takes the estimated average annual income and divide it by the average investment, all right? And so the average investment, they show you how to do that. You have the initial cost, okay, so whatever you're paying for that. And again, that includes transportation, taxes, whatever it took to get it into its intended use. Then you're going to add the residual value. And again, if you remember, residual value is what we think we can sell that thing for when we're done with it. All right. What value does it have when we're finished with that? And then we just divide by 2. Okay. And so this gives us something that is similar, okay, to the rate of return. Right. A couple chapters ago when we calculated, a division, okay, its rate of return, we just looked at the income divided by sales, right? Well, it's kind of similar to this, right? But in this case, I'm sorry, not sales, by total assets. This is basically taking the income divided by, the asset that you're purchasing. Right? So we have some information here. We have the cost of the new machine, right? We have a 0 residual value. We have the estimated cost, total cost, right, from the machine, right, and it's 4 years. And so what we're going to do first is calculate the average investment. And so, we took the 500,000, what it cost us, plus the residual. There was no residual in this case. We add those two together, divide by 2, all right, we come up with 250. All right. Then, all right, we divide the average annual, okay, income. So, back here it said that it was, 200,000, but we're going to divide that by 4. And that's how we get the the $50,000. Okay. And so it turns out that it's 20%. Okay. So what do you guys think? Good? Bad? Indifferent? Okay. Yeah, coming up with that number really is not helping you with the decision unless, okay, you had what is referred to as a hurdle rate or your required rate of return. Okay. And so let's say that your required rate of return, okay, equaled 25%. Okay. If that's the case, okay, we'd say no, right? Do not buy this thing, right? However, if your required rate of return was 15%, we'd say yes. What a terrible looking S. All right. Yes. Does that make sense? Okay. You have to have something to compare it to. And this would be something that your firm would have individually, specific for your firm. Okay. And so, that's what it's just saying. You're comparing it to a minimum rate of return, right, or a required rate of return. The average rate equals or exceeds the minimum rate, then it should be purchased or considered for further analysis. Again, this one's a weak one, all right? The reason being, let me go back to here, all right? Let me just say, we know that, the cost of this new machine is today, right? I mean, you can't get much worse than this, right? 0 residual value. But again, this is an estimate, okay? And that's something in the future, isn't it? We don't know what that is, okay? It's sometime in the future. Again, we have an estimated income, okay, of 200,000, right? So we assume that it's $50,000, right, every year, okay? But what if, okay, we get $10,000 this year, okay, and then nothing, okay? Then we get the 190,000 in the fourth year. Okay? Are those 4-year-old dollars, okay, are they worth the same as a dollar today? So again, the time value of money, okay, it's better to have a dollar today, right, than it is to have a dollar in the future. Okay. Well, actually, let me change that. Let me put this up here. Because if we had a dollar today, we'd end up with, right, 10%. We'd end up with $1.10 in the future. But let me show you, all right, what is this dollar a year from now? What is that worth today? Well, it's actually worth 90.9 cents. Because as you'll see, we're going to have the present value factor, right? We'll talk about this a little bit later, all right? And so, if we were saying, hey, this is now, change this. This is, 1 year. This is 4 years. Right? And I said, hey, what if you got that $190,000, okay, in the fourth year, okay, and you got $10,000 here? So is this worth, okay, the same 190,000? I didn't have enough zeros there. All right, is it worth the same? It is not. It's worth less. But is that even taken into account under this method? No. The other thing, all right, is it takes into account income. Okay, let me highlight that. It takes income and not cash flows, right? Where cash flows are actually better than income. So yeah, pretty weak method. But was it easy? Yeah, it was really easy to calculate. I would need a calculator, but if I was out in the field, if I just had a normal calculator, that would be really easy to calculate, wouldn't it? So that's why we even talk about it. The average rate of return has the following 3 advantages. All right, it's easy. I just said that. It includes the entire amount of income. Okay. earned over the life of the proposal. It emphasizes accounting income, which is often used by investors and creditors in evaluating management performance. However, the weaknesses, all right, it does not directly consider the expected cash flows. Right? It doesn't look at cash flows. It looks at income, right? And it does not directly consider the timing, right? The time value of money. The next method, right, switches things up, all right? The next method is called the cash payback period. And I don't know if you've ever, heard anybody, say, hey, how long does that take to pay for itself, right? That's really what we're looking at here, right? The expected period of time between the date of an investment and the recovery in cash, right, is called the cash payback period. And so there's two different types, right? There's one where you have the same cash flow, right? And so, the annual net cash flow, all right, is the same amount. Okay? We call that an annuity, all right? It's hard to say, annuity. It's called an annuity, all right? When annual cash flows are equal, right, that's an annuity. That's an annuity. It's really easy. We just have whatever it cost us, all right, that's the cash outflow, okay, divided by the net, okay, and the net means we're going to take the inflows subtract the outflows, all right? Okay. So the net amount is just taking the inflows, divided by the outflows. And so here we assume that management is evaluating the purchase of a new piece of equipment. All right, the cost of the new machine is $20,000. Cash revenues from the machine are $50,000. Expenses of the machine are $30,000. But all right, the depreciation of that machine is $20,000. Okay? And so really, what we're going to do is we're going to say, hey, this $30,000, okay, is not really all cash. Right? It consists of $10,000 in cash and 20,000, right? Of depreciation expense. This is a non-cash, right? And so really the cash outflow, all right, is only going to be 10. Right? And so we have revenues, right, of 50, cash inflows of 50, cash outflow of 10. So the net cash flow, all right, is this $40,000. And so, all right, now that we know the cost, right, and the net cash flow, we could just divide it and say it's going to take 5 years for this piece of equipment to pay for itself. So the question then is, should we do it? Okay. Well, we need to have some sort of expected payback period. All right. And so if our company says, hey, you know what, we want to make sure that everything pays back in 4 years. Oops, that's not what I want. Okay, 4 years is required. Okay. All right, then we'd say no. We'd say no to this investment. Why? Because it was 5 years, right? That is over, okay, our cutoff or our threshold. Right? However, okay, if it said it would, it was 10 years, okay, required, okay, then we say, yeah, right, this, pays for itself in 5 years versus the 10 years. And so generally you would think, hey, the shorter number of years, the better, right? So if we had another proposal that only took 4 years to pay for itself, then we'd probably choose that one over this one, right? Does that make sense? And so in the preceding example, the annual cash flows are equal to $40,000 per year. When the annual net cash inflows are not equal, all right, the cash payback period is determined by adding the annual net cash inflows until the cumulative total equals the initial cost of the proposed investments. And so here's a scenario, okay, where, instead of it being the same amount, okay, we're saying that over here, we have these cash flows. And so, this 60, right, gives us a 60. So 60 plus 80 equals 140. 140 plus, right, 105 gives us 245. Right. So you see how they're doing this thing? Okay. And so we can see, all right, that this thing cost us, all right, $400,000. It paid for itself in the 4th year. Does that make sense? And so if you're trying to consider between this proposal and, this proposal, which one would you do? Okay. Would you choose one with 5 years, or would you choose one with 4? Well, the criteria would say, no, you would choose this one. All right, you would choose this one because it paid for itself in a shorter time period. Well, there's several weaknesses about this one. All right, and I want to use the same information. All right, in order to show you one of the weaknesses. Right? And so let's look at an alternative proposal. Okay, and let's say that in the first year we had 60. Okay, in the second year we had 80. In the third year, we had 105. Okay. And in the fourth year, we had 55. And then in the fifth year, we had 100. Okay. And so at this point, at year 5, okay, we hit 400,000. Okay. And so which one would you choose? Okay. My hope, okay, let's just say this is A and this is B. All right, from what I've said so far, okay, you would choose A, right? Because it paid for itself in 4 years, where B paid for itself in 5 years, okay? But let me add the 6th year, okay? Let me add 15 million dollars, all right, in the 6th year, okay? If you followed the criteria for the cash payback method, you would still choose A because it paid for itself quicker than option B. However, option B has a huge 6-year payout, all right, compared to this, all right? And so one of the weaknesses of the cash payback method is it completely ignores, all right, the cash flows that happen after the payback. Because we completely ignore that and we completely ignored that, all right, under our rationale. We would have chosen A and we would have missed out on that $15 million payout in year 6. Right? So that's one of the weaknesses of the cash payback period. So the cumulative net cash flows at the end of year 4, yeah, so the payback period for this one was 4 years. A short cash payback period is desirable. Okay, so that's the criteria. This is because the sooner the cash is recovered, the sooner it can be reinvested. In addition, there's less chance of losses, right, from change in economic or business conditions, right? And short cash payback period is also desirable for a quick repaying of any debt used to purchase that investment. The cash payback method has the following 2 advantages. Again, it's simple, okay? And instead of looking at income, it looks at cash flows. However, the disadvantages, it ignores, and this is what I was trying to highlight, after the payback period. And it doesn't take into account present value concepts. Right? It's just looking at, they're making the assumption that $1 today is worth $1 a year from now. And as we know, that's not the case. Right? Money is not free. There's a cost to money, right? And that is interest, right? And so the time value of money is interest expense. Taking a drink of coffee there. All right, so moving on. Methods that do use, all right, present value, if you remember, there's the net present value method. It's even embedded in the name. And there's the internal rate of return. So an investment in a fixed asset may be viewed as purchasing a series of net cash flows over the period of time. The time of when the net cash flows will be received is important in determining the value of a proposed investment. Present value methods use the amount and timing of net cash flows in evaluating the investment. Okay. And so there are two concepts that you need to understand. Okay, there's the present value of an amount, all right, or of $1, $1, and then there's the present value of an annuity. Okay, we talked about an annuity already. Okay, that's the same amount at the same increments of time. Okay. And so, all right, they're just going to run through some of the time value money stuff that we talked about. It says, assume that you have $1 to invest. Okay, you know, you're going to invest it for 3 years at a rate of 12%. All right, and so we're going to use a timeline. Okay, and we're going to grow this dollar. So this looks really confusing. All right, don't worry about it. All right, the picture paints 1,000 words, but basically they're saying that as time goes by, interest earns interest, all right? And so we had this dollar, okay, we multiplied that times 12%, right, as the passage of time. Because if you remember, interest equals the face times the rate times time, right? Okay. In this case, all right, it's a whole year, so this is really just 1 or 12 over 12, right? Because again, interest rates are always stated as an annual percentage, all right? And so if we had the face of $1, all right, times rate of 0.12, okay, you know, we come up with 0.12. But a quicker way to do this, all right, is to just take that interest rate plus 1. Okay. So that what that does is it saves you from then having to take, you know, the 12% plus the base amount, all right, giving you 1.12. All right, it's just a quicker way to do things. So what we say is we have this dollar, all right, it earns 12 cents in the first year. But now, instead of just having a dollar, okay, we have a $1.12, okay, and it's going to earn 12% interest also, all right? And so, you know, our interest earns interest, okay? And so what we can see is that, hey, you know, we actually earned, all right? So if you just subtract that, we earned 12.34 cents. Okay, where we only earn 12 here, okay, now it's, you know, 12 or 13, I'm sorry, not 12, 13.4. Actually, I should say it's between years 2 and 3. And then again, our interest, okay, earns more interest, okay, and so we end up with, you know, a future value, okay, of $1.40. Now, this is the whole idea and concept of saving for your retirement, all right? And if I can give you some advice, all right, from, you know, do as I say, not as I did, all right? So when I went to Hawaii, all right, you know, I worked for several years in public accounting, but then I ended up working for a mission organization where I didn't pay in any retirement. Then I ended up going to work for Faith Writing Company, and again, you know, I didn't have any retirement there. Okay. So it really wasn't until I went to Central Washington University, okay, as a full-time instructor, where I started paying into my retirement. Okay, and so pretty late in life. Okay, and so my retirement hasn't had the chance, all right, to earn interest on its interest. You know, so I've been paying pretty good, all right, into my you know, 401k and my Roth IRAs and things like that. All right. But, I'm, probably not going to be able to, retire, all right, until I'm in my 70s, right? Because, and if you ever watched any or heard of any Dave Ramsey stuff, he has a scenario where he has two brothers, right? One brother starts investing when he's 18, right? But he stops, I think, when he's 28. The other brother starts investing at 28 until he's 65 years old. Guess which brother had more money for retirement at 65? Yeah, the first brother. And the reason being is this whole idea of the time value of money, right? He's putting money away today, and his money is working for him a lot harder, okay, because he has more time. And so his interest is earning interest and so forth and so on, all right? And so if I can encourage you, all right, start saving for your retirement now, okay? There's a wonderful program, even if you don't have a job that offers you a 401k, all right, which is a retirement plan. There's this thing, it's called an individual retirement account, all right, an IRA. And there's two types, and I highly recommend using the Roth IRA, okay? And so if you can put, I think this year, I think you can put away $6,000, right? If you can somehow save and invest $6,000 into your Roth IRA, you're going to be way ahead of the game, all right, when you retire, okay? The benefit of a Roth IRA is the money that you put in, okay, as it earns interest, it earns interest tax-free. And so when you retire, you can take all of that money, all the money that you put in, and the interest that isn't earned, okay, you can pull it out completely tax-free, all right? It's the best method. All financial advisors would advise you to do the Roth IRA. All right, so moving on. Present value of an amount, okay? So let me go back here and show this picture. What do you think, all right? What do you think the present value of this is? What do you think the present value of $1.40 3 years from now is today? Well, that's what's referred to as discounting. And so if we were to bring that back to today, yes, it's worth $1. All right. Ooh, rocket science, right? And that's really what we're trying to do, because we're trying to get into the present value, okay, when we make our decisions. All right. So what we're going to be doing is we're going to be discounting these payments. Okay. Cool. Now take note. All right, how many times did we put that dollar in? Okay. We just put that in once. And then we earned 12 cents, then we earned 13.4, and then you can figure out the difference here, something like 20, or not even that, I don't know. 15, so somewhere around 15. Yeah. So on January 1st, year one, what is the present value of that $1.40 received 3 years from now, right? Well, it's worth, the dollar today. And how we're going to calculate that, all right? You could have worked that backwards if you wanted, all right? But there's this, somebody told me, and I don't know how accurate it is, so you might want to fact check me, all right? But apparently some brilliant 10-year-old way back, I don't know if it was Aristotle or something like that. I think it was a Greek kid or something like that. He came up with these present value tables, right? And so here's an example of a present value table, right? What it does is it has the interest rates across the top and the periods down the line here, okay? Know that periods are usually referred to as N. That's a W. N. Where interest rates, all right, are referred to as I or Y in some cases, right? In everything that I use, it's I, right? And so if we were to go back and look at our scenario, all right, we said, hey, that this thing was a 3-year, okay, 12%. So this is N, this is I, okay, and we can use the table to find out what the present value factor, okay, of one payment, that $1, okay, at 3N and 12I, and it's going to be this thing right here. So how this works, all right, you can do it either way, all right. You can either go across the top and you say, oh, hey, here's my 12%, okay, and then, here's my 3, bring it across, and whoa, why is that one yellow? Okay. All right, that's referred to as the present value factor, okay, of 1 for 12I and 3 and And so you'll see this thing, in other textbooks. You're not going to see this here. All right, I'm just kind of laying the groundwork for your future. All right, all right. So that's how this table works. All right, this is the present value factor, or the present value table for $1. Okay, one payment. Okay. All right. And so you could, this is how you're going to calculate it. So the present value, okay, present value amount, okay, is the $1. And we could have looked at that in the previous one too. Okay. The other thing we need to know, all right, is this thing called an annuity, all right? And really, your Roth IRA, okay, is an annuity, because if you can put away, okay, every year, okay, $5,000, say it used to be $5,000, it's now I think $6,000. This is going to earn interest, right? Earn interest to here. So you're going to have, 10,000 investment plus the insurance. Okay. And then this is going to earn interest along with this one. Right? And so, this is the whole idea of your retirement. All right, you're putting money away and you're doing the same amount, $5,000 every year, okay, until you retire. Okay. With Dave Ramsey's calculation for that first brother who only put away, and I think it was $5,000 from age 18 until 28. Now, the interest rate that he used, which was really high, and I don't know if it's really attainable, all right, I think he used 13%. All right. He did a calculation that, at 65, that first brother would have over $3 million, right, just from his Roth IRA. Okay. So he had $3 million tax-free that he can use for the rest of his life. Right? But this is called an annuity, right? And it's usually, we're not going to talk about, there's 2 types of an annuity, all right? This one is an ordinary annuity, which is ordinarily used. Okay? And so the present value of $100 annually for 5 periods at 12% could be determined by using the present value factor tables, the first table, right? And we just have to do it year by year by year, okay? Or we can use another table, all right, which is called the present value of an ordinary annuity for $1, okay? And we'll see that here in a second. Okay? But what they're trying to show you is if we used the first table, okay, this was for 1 year, and this is for 2 years, okay? And so, looking back at that table, we could find that these present value factors, do you remember this one? That's what was for the 3rd year, right? And so we're saying, hey, this $100 is actually only worth today $71.20. Okay. If we discounted it, I think it was at 10%, or no, 12%, right? 12%? 12%. Okay. Does that make sense? Okay. And so really what we're saying, today, okay, if we had, made all of these payments, or think about this, you won the lottery, okay, and they said, hey, they'll pay you out, let's say there's 100 million, okay, $500 million, all right, $100 million a year. Well, what is that really worth to you? Well, that's really worth $360 million today. And that's really how those lottos and stuff work, right? They pay you a certain amount, okay, an annuity, okay, for the next 20 years or whatever. It's really not worth the 500 million. It's really only worth 360 million. We discounted that into today's dollars. Okay. So you could do it this way, right? But that seems awfully long and time consuming, right? Or you could use the present value of an annuity table. Well, that sounds like something we want to do. Okay. And again, apparently some 10-year-old kid came up with this thing. All right. And so if we were looking, right, if you remember, we had the $100. Oops, that's not. We had the $100. Okay. And if we used, was it 100 or 500? Yeah, it was 100. Okay. And if we use this table, again, we're using the 12%, right? This time we're at 5 years, okay? And we come up, right, with this present value of an ordinary annuity for 12I and 5N. And if we multiply this times this 3.605, okay, we come up with that 360 that we did over here. Right? Make sense? It's just a quicker way. And really what we're trying to do here is we're trying to lay the groundwork, all right?
Your big butt off my computer, Hank.
What's that? Hello? Maybe somebody was Zoom bombing us. I don't know. All right. I don't think so because I have everybody in the waiting room. All right. And so here we're looking, all right, what they're just showing you. If we use the first table, okay, here's all the present value factors. We add them up, and that's how we came up with the present value of an annuity. So the two methods that take into account the time value of money, all right, are the net present value method. Okay. And as I said, this one is the best, right? If this one conflicts with any of the other ones, you ignore the other ones and you stick with this, this method, right? The net present value method and the present value index are often used in combination, right? The net present value method compares the amount to be invested, right, with the present value of all the future net cash inflows. It's sometimes called the discounted cash flow method. Right? The interest rate, all right, used in the net present value, all right, is the minimum desired rate of return. Okay. Now, if you do the Ferris program, all right, you are going to take Finance 322, and basically the bulk of that semester, all right, we are going to learn how to calculate the minimum desired rate of return. Okay. Luckily for you guys, all right, this is always given to you. All right, so this is the rate, sometimes termed the hurdle rate. I mentioned that earlier. Okay, based on factors such as the purpose of the investment and the cost of obtaining funds for the investment. All right, know that this is what's referred to as the weighted average cost of capital. All right. If the present value of the cash inflows equals or exceeds the amount to be invested, the proposal is desirable. Okay. And so this is the criteria. Okay. If it's a positive number, okay, you accept. If it's a negative, you reject. And so here we have a scenario. Okay. Assuming the following data. Okay. So we have a cost, right, of $200,000. Okay. We have cash flows. Right. These are unequal cash flows. So is that an annuity? No. So we're going to have to use table 1, okay, the first one that they gave us, right? And we're going to have to do each year individual. Okay, we have the desired rate of return or your required rate of return of 10%. And so what we're going to do is we're going to do our calculations. Right? And so from the table, okay, we look for the 10%, right? We look for 10% I, And then we're just going to go down for each line. Do you remember when I calculated the, I think the first time I calculated it, where I said, hey, this dollar in the future is really worth 90.9 cents? Only because I remembered that number, all right? Because that's the discounting factor, right? So we're taking these cash flows, so this is year 1, 2, right? So they correspond here. Here's 1, 2, and all we're doing is we're taking those, we're adding them across, okay? And you can see that the present value of all those future cash payments comes out to be this 202,900. And so we end up with a positive 2,900, all right? And so we're going to accept, right? Because it's positive, right? And know that this increases, right, the owner's equity, all right, by 2,900,000. If we were to look at the table, I like this table the best, all right? You know, because here is where we're purchasing. This is the outflow, right? These are all inflows of cash, right? And we come up with 2,900. We would accept this proposal, right? So the net present value of 2,900,000 indicates that the purchase of new equipment is expected to recover the investment and provide, right, more than the minimum rate of return of 10%. Thus, the purchase for the new equipment is desirable. So the advantages is it considers the cash flows, all right? So, you know, we're looking at cash flows, not income, okay? It takes into account the time value of money, okay? And it can rank projects of equal lives using the present value index. Negatives, all right, it's complex, okay? And it assumes, all right, that the cash flows can be reinvested at the minimum desired rate of return, okay? And so I actually, all right, and I'm not going to prove it here, okay? But this one, I really feel is not a valid disadvantage, all right? Wait until you take Finance 322 for me, and I will prove that, all right, to you. All right. But whatever, we'll leave it there. Before in here it said it can rank the projects, all right, using this present value index, right? Well, the present value index, right, what that does is it takes the total present value of the net cash flows, all right, so in our case it was the 202,900, right, divided by what was invested, the 200,000, okay, and it comes up with this 1.0145. Know, all right, that, you know, if this is an acceptable one, it's going to be at least 1, right? You know, because that would have meant that we had 200 divided by 200, okay? You know, for something to be acceptable, there has to be either positive, okay, and or the same amount. So 200, if the cash flows were 200, then that would have given you a 1. There's a problem, I think, in your homework, or maybe it's on the exam, that, you know, asks you to select, all right, which one of these would be rejected or something like that. And if it's less than 1, okay, then you'd reject that one. But what this does is it allows you, all right, you know, to compare, okay, which one ever has the largest. The largest is the best. Okay. And so a project will have a present value index greater than 1 when the net present value is a positive number. So I mentioned that. When the net present value is negative, all right, then it's going to be less than 1, and therefore we would have rejected that proposal. And so we're looking at these things, all right, and so this one we're rejecting, right, because it's less than 1. It's a negative number, all right, so that's why we're rejecting that one. And so between these two, which one are you going to go with? All right, you're going to go with this one, okay? Because you invested less, okay, or I should say you invested less, and you got a better return. Okay? So this is the best one. Proposal B is the most desirable. Next, we're looking at the internal rate of return. Okay. Now, it cracks me up. This conceptually, all right. we're going to look at this, but know that you will not have to calculate this on the exam, right? Because it's ridiculous the way that they're showing it to you, and I will prove that. Without a calculator or a computer, right, this is pretty difficult, all right, to calculate. So this method, sometimes called the adjusted rate of return method, starts with the proposal's net cash flows and works backward to estimate the proposal's expected rate of return, all right? And so what we're doing here is we're trying to calculate, right, the interest rate. So we're going to know, all right, we're going to know the present value, the future value, okay? We're going to know N, okay, but we're not going to know I. So we're going to question I. So we're trying to figure out what the interest rate is, knowing that the present value and the future value are going to be the same, okay? Or I should say not the future value, but the cash flow. Yeah, that's this is Acco. And we're trying to solve for I. Right? And so here we have our calculations is saying, hey, assume that the following proposal, all right? And so what we know, okay, that this is 5 years, 1, 2, 3, 4, 5, all right, and so we know that we're going to get $10,000, $10,000, $10,000, $10,000, $10,000, $10,000. We know that we're going to spend, all right, 33, 530. And what we want to know, okay, is we want to know, right, if we were to take the present value of all these 5 years, okay, this total, all right, would equal 33530. So that our net present value equals 0. Okay. So at what interest rate would that happen, right? See, they give us the minimum desired rate of return, but if we use this, right, we're going to come up with a number that is higher, okay? This is not going to equal 0. This is going to be a bigger number, right? And you can do that if you want. On your own, you could calculate that. What we want to know is at what interest rate, right, would the present value of all these annuity, okay, give us to come up with this 33,530. And so it's a guessing game, all right, and that's how they suggest that you do that, all right. So you're going to run it at 12, all right. You're going to say it'll come up, it's going to be higher, and so then you're going to run it at 18. Oh, then that gives you a negative number. Then you run it at 13, and that gives you a positive number. Then you run it at 17, that gives you a negative number, right? And then I think it's 15%. I can't remember, all right. But when you hit, the 15%, that's when it comes up to be 0. It's called trial and error. Okay, not very effective, right? If you had the BA2 plus, right, it's 5 keystrokes on your calculator, all right. But let's walk it through here, all right. One way, all right, so here's using the 12%, okay, you came up with a positive, all right, 2,520, right? So you know that it's paying more than 12%, right? And so that's when you try maybe, 17. That one's going to lead into a negative, right? And then so you try 13. That's still going to give you a positive. Then you try, 16, and then, and so on and so on and so on. All right, until you find out, all right, where this equals 0. Okay, that's your goal. All right. So yeah, um, you know, it represents, in this case, so it must be greater than 12. All right, and so you through trial and error, okay, you work backwards, whatever, and then you do finally, it is that 15%. All right, so if you did the 15%, all right, and you did the net present value method, woo, all right, we come up with the zero that we're desiring. What that means is that our internal rate of return, okay, equals 15%. Now, a lot of managers like this, all right, because they can basically say, hey, what kind of return does this piece of equipment give me? And you can say 15%, all right? Instead of looking at, the net present value as a number, they just like to have that percentage, all right? Because, all right, our required rate of return was 12, okay, then this would be an acceptable proposal, wouldn't it? Right? Because this is more than 12, it's 15%. And so, yeah, this, the trial and error method, it's very difficult. All right. Another alternative way, okay, happens only, okay, when you have an annuity. All right. And so again, if you remember, an annuity is the equal annual. Oops, that's not what I wanted. All right. The equal annual cash flows. All right. And again, that's an annuity. All right. We can utilize another method. Okay, but I'm going to show you how this is pretty lame too. All right, so first of all, determine the present value factor for an annuity of 1 as follows. Okay, so the amount to be invested, we have that. Okay, and we have the annuity. Okay, and so next we're going to use this table and we're going to try to determine, where this thing falls on the table. So let's use some numbers here. Okay, and so we have, the cost of the equipment. Okay, and we have the yearly expected cash flows. So what we're going to do, right? We're just going to, well, first of all, let me do this here. 97,360, and we're going to divide that by 20,000. Okay, and this comes out to be, it's on the next slide. All right, it comes out to be this, 4.868. Well, we knew, okay, that this was 7 years. What we're looking for is we're looking for I, right? We're looking for the interest rate. And so we go down to the 7th period. Okay? We go across until we find that number. Okay? Then we just go up, right? And we can see that, oh yeah, that was 10%. Okay. But let me say, okay, and this is why I think this is lame. All right, let's say that you actually do this calculation and you come up with 4.612. All right, making it up as myself. All right, and so 7 years. So you're going along here, and you actually stop. Let's see, it's roughly, yeah, right here. Okay. So what is that one? Well, if you go up here, maybe you say, that's probably around 11%, right? Okay. But we don't have a table that gives us this number. We have to guess, all right? Lame, all right? However, if you go out and purchase a Texas Instruments BA2 Plus, this will calculate it for you, all right? And it's so easy. It's painful. All righty. So looking at the advantages, all right, it considers cash flows, considers time value of money, and it automatically ranks proposals. All right, we didn't have to do the present value index. Right? This one is a lot more complex. All right, and it assumes that this one is legit. All right, this one is legitimate. All right, it assumes that the cash received. All right, and so what we're talking about is we're talking about these this $20,000, okay, that we expect to receive, that we can take this $20,000 and reinvest it, okay, at 15%. That may not be the case. Okay, that's what this is saying here. Yeah. Some additional factors that can really mess things up. all right, income tax proposals with unequal lives, lease versus purchase. Okay, this one that cracks me up. All right, uncertainty. What you mean? Looking into the future, making estimates. We might not make the right estimates. Huh? Okay. What you mean? Things can change, all right, over time. Okay, so those kind of crack me up. So we're not going to take the time to go into each one of those. The textbook does, all right. Read through it, but don't spend that much time on it. Okay. There are some qualitative factors, and we will address those. All right. And then also, they talk a little bit about sustainability. All right. And so, when it comes to uncertainty, all capital investments rely on factors that are uncertain. Really? All right. Oh, you mean our crystal ball that we picked up from the bookstore doesn't work? Yeah. All right. There's so many different estimates that we're making here. Things could be wrong, can't they? But it's better than just shooting in the dark, right? Trying to make the best estimate, right, gives you a basis and actually protection. So if somebody ever asks you why something went wrong, you can say, hey, this is the assumptions that we made, okay, and this is why we made them. Okay, we just didn't pull them out of thin air. And you can kind of support why you made the decision that way, probably saving your job, all right? Qualitative factors, all right? We talked about those a little bit last chapter, all right? The qualitative things are really the touchy-feelies, all right? The quality of your product, all right? Flexibility of your manufacturing, employee morale, marketing productivity, all right? Market strategy and such, all right? So let me give you an example, all right? We have two pieces of equipment, all right? We run our, net present value method. They're both positive, all right? We run our cash payback period, and they're both within the required limit. We look at the average rate of return, and that meets our criteria. Internal rate of return meets our criteria. Okay, but proposal B has a real comfortable seat. And so even if proposal A, right, had a little bit higher return, okay, had a little bit higher net present value, okay, you might choose B just because of that comfortable chair, or maybe because of the color. All right, those are qualitative things. All right, that you need to consider. All right, because your employees are going to be sitting on that machine. All right, and if they're uncomfortable, okay, they're not going to be as productive. Right, and so again, you need to bring into those qualitative components to each one of your decisions. Sustainability, all right, in the world that we live today, all right, it's huge, isn't it? Sustainability is the practice of operating a business to maximize profits, okay, while attempting to preserve the environment, economy, and needs of the future generations. Sustainability practices often require capital investments in order to establish these priorities. Right? And so it's amazing how there's a lot of companies out here, and one that's quite interesting, all right, is Exxon, right? Yeah, the oil company, all right. They are trying to change the way that they extract oil from the ground, right, to be more environmentally friendly. All right. Some examples of capital investment sustainability, all right, minimize resource waste and environmental degradation, all right, you know, develop new sustainable markets, reduce litigation risk, right, maintain an attractive and safe work environment, right. Don't have my glasses on, but yeah, and how they could invest into fixed assets, right, to obtain those things. Capital rationing, okay, is basically the process of trying to figure out, so you have a bunch of acceptable proposals, right? Which one should you choose, all right? And so there's this decision tree, all right, that I think really lays it out well, okay? We first of all have a proposal, okay? We have various different proposals, okay? And so you might be looking at it and you run the minimum cash payback period and average rate of return, okay? And both of those, all right, say, hey, reject this proposal. Okay. Now, is this a garbage can? Okay. Is this a garbage can? The answer is no, it is not. All right. It is a file. Okay. We're going to file those away, all right, for future evaluation. See, one of the difficult things with capital asset, purchases is coming up with, possible proposals, right? And so just because something is rejected now, we may not reject it in the future. Okay? And so, but let's say it says yes, okay? And then so we're going to do a future analysis, okay? And so maybe we run the net present value and internal rate of return, okay? And those bump it out to no. Again, that is not a garbage can. We file that for later evaluation. But let's say it passes that one, okay? Then it comes down here, and then we say, hey, the qualitative things, all right? Do they change our decision, right? Yes, okay. Well, then again, that's not a garbage can, right? We put it there for later consideration, right? With the ones that we rejected earlier, okay, do some of the qualitative things make them acceptable, right? Yes, right? Then we're going to accept the proposals that we can, all right? We're going to rank those, all right? And usually we have limited money, all right, or capital funds available, all right? Yes, do all the ones that we have the cash for, all right? Again, if we don't have the cash, maybe do some that we can pay for, and some we're going to file away for future funding, right? And so this is the whole idea of capital rationing. And so that ends our semester. All right. So good job. You guys made it through. All right. Principles of accounting. All right. I am proud of you guys. So, you guys stuck it out. You guys were, even in a very unique semester. All right. You guys have made it to the end. So I'm really proud of you guys for sticking it out. So let me stop recording here.